that we go Facebook.
Yeah.
Facebook doesn't kick us. That's the only key here. We always have to make sure Facebook doesn't kick
Yeah.
us.
Yeah.
We have this very short 1 minute window. So, okay, looks like we are all on live with all three platforms. We are on Facebook, we are on LinkedIn, and YouTube. Okay, great. Woohoo! So we are today, November 18, episode number 6, guys. Good morning, friends. Thank you so much for joining us today. For those of you who are joining us, returning, thank you so much for your support. We really appreciate it. Big high five for you. And then those of you who are joining us for the first time, give us a thumbs up so we know you are here for the first time. And again, thank you so much for your support. To introduce myself, my name is Marie Torossian. I'm a CPA and a chartered global management accountant. I'm an experienced auditor and a CFO. I'm currently a CPA advisor and transformation coach. So I've authored a couple of books, and I have the information in the link. I have the operational business owner's guide for operational accounting and the complete guide to business growth. Again, the links are below. I don't want to take too much of our live time because we have so much to discuss. The main work that I'm doing right now is through the methodology that I created. I call Valuation MT. That I will do a very separate session on that, and I use that framework to bring in a lot of my auditor and CFO experience and grow $1 million businesses to their next 10 million and more. Today is my guest is again my friend and my tax colleague Pedro Gonzalez CPA. Pedro, please introduce yourself.
Good morning. Yes, thank you. And once again, it's a pleasure to be here. And my name is Pedro Gonzalez, a business and tax strategist. I also have an ebook. I forgot once again to put the link.
Come on, Pedro.
I know. But I have been receiving some good feedback on that. Is the guide for real estate investors, the tax strategies for real estate investors, which is motivating me to continue expanding on that. We have the tax-wise system for how to minimize your taxes for business owners. Basically, it's geared towards entrepreneurs and real estate investors. So, in a way that guides individuals to maximize, and we're going to be touching some of the things in this podcast today. So you can see to start understanding, it's more about educating our clients and helping them better understand, so they become really tax-wise about how to combat this system.
Yeah, absolutely. So, in the past few episodes now, we have talked about, importance of record keeping, bookkeeping, self-employment, tax deadlines. We started a conversation last week about a little bit of tax planning. We touched base on a little bit on the life insurance and how that fits in with the tax planning. So, guys, if you want to hear out those items, if you have questions on that, you can always go back and check out those episodes as well. But today, we want to focus on really guiding you through the different types of income. And when we talk about net worth of an individual versus their income, and how does that fit into tax planning? So, Pedro, I will kind of bring it up to you to kind of take over from those two key items, how you want to plan out the discussion. So I would think maybe from the different types of income to kind of make that clear, but I'll leave it up to you. So you can take over.
Yeah, this kind of started. I was telling Marie, we were having this conversation, how the importance of the understanding of taxation. I was sharing, a lot of this, and also what motivated me to continue, in essence, focusing more about the topic of the tax planning. We were talking about, for example, Elon Musk. I was talking to somebody who was livid about the fact that this individual is paying so little in taxes. Now, the reason is that we really do not understand, the majority of the people do not understand the tax system. In essence, that we're playing a game, we don't understand the rules. So we're getting hurt because we're playing this game, but we don't understand it. So this is the importance of this type of documentation that we have, all these videos that we're putting together, the ebooks and all of that, is to educate our clients So if they gain a better understanding, they can actually play this game and actually come ahead. The only way that we're gonna improve taxation erodes wealth. But if you don't understand it, then that's what's going to happen. So you have to be able to counteract this. How is it possible that this individual pays so little taxes? So one of this is kind of start giving you some light into how is that possible. So we're going to start with something basic, because I think that the number one thing that we need to understand is that in order to understand how to pay less taxes, which is the goal of tax planning, is that you have to understand how the taxes are actually work. So in my experience, it's about 90% of the people out there that have no idea how the tax system works. They're honestly, and I will say this respectfully, they're clueless. I mean, and so they are out there and they do not understand how that system works. They get frustrated, they get angry, they see the media putting all this information. So I understand. I mean, they're upset. How is it possible that this individual pays less tax? Now, the tax system is not written only for the wealthy. I know that that's a kind of a preconceived idea we have. It's not. What happens is that most of us do not understand how to extract the information, how to apply it to each of us. But there's benefit for all of us. It's not exclusive. It's that we need to understand at least how the tax system taxes different types of income.
Sure.
And unfortunately, the what I call the clueless group includes also tax practitioners and financial advisors. You know what I mean? So they're gonna, it's not limited to the taxpayer. It's that there's also individuals out there that have no idea. So they're passing, in my opinion, the wrong information. In the process, people are overpaying taxes. So today, I want to again focus on at least the three types of income. And how is it that it's going to get taxed? I have mentioned before that the tax law is not written for the employee. It is, it is written really is for investors, for business owners, the entrepreneurs, the investors. That's really where you're going to see the tax benefits. So what you have to do first, you have to understand the three types of income. And you have to understand how each one is being taxed. So then you can start developing, how can I move my income sources to a bucket. Another bucket is going to get taxed exactly. It's going to get taxed less. It's going to have a lesser impact. And that's what the wealthy does. I mean, they're constantly and this is like a chess game. I make such a move, you make a move, okay, I'm going to make another move.
Correct.
That's how you have to look at it. I mean, it's you versus the IRS. So, or the Congress. It's not really the IRS, but it's more the Congress, the tax laws.
Right.
So then how they make this move, you got to make this other move. And you got to be 1 or 2 steps ahead. And that's really what tax planning is. That's why a lot of people do not understand what tax planning is and the strategies that go behind it, because you have to be 1 or 2 steps ahead to help you get sideblinded. You know what I mean? Because you were not prepared, or you're acting on laws that were in the past and no longer applicable.
Right, that's true.
So the three basic types of income you're going to have, and some other people might say that there's more, but basically, really, there's 3 types. One is the active. Then number 2 is what we call portfolio, and number 3 is what we call capital. Active is going to be wages, for example. As an example, that will be wages. That will be in that bucket that we call active income. That is the worst possible tax treatment you're going to receive. Like I said, the tax law is not written for employees. And the reason is because active income is subject to ordinary tax rates, which is going to be higher. And also, on top of that, you pay the FICA tax. That's something that we don't hear a lot, you know what I mean, is that what you take home is already being taxed. So you're operating, so you start thinking about it, is that the money you're bringing home is already taxed. So you're already starting from a negative. A reduction. So you see, that's why the tax law is not written for the employee, because they're operating is with taxed already. They shaved a portion of that.
Right. You're getting net of the
FICA. Exactly. And you have to plan, okay, how can I mitigate that? But we're going to discuss that either today or in another episode, but you have to start thinking about this. And this is again the importance of the education, is because
Yes.
a lot of people do not understand. They receive a refund and they're woohoo. All
Right, right,
they overpaid income tax. That's it.
right.
You
And
know,
I
you
think there's
overpaid
also
tax,
a way,
and they're returning it.
right. And I think a lot of times I believe there is a confusion between what is their FICA taxes and the income taxes.
Correct.
Because
Yeah.
they're like,
Mhm.
what is
Go
that?
ahead. No, go
Yeah.
ahead.
Yeah, they get confused between the FICA and then the income. And then they were like, the FICA is actually for the payroll. It's going towards your Social
Correct.
Security, Medicare, and all that. And then you get a paycheck net of those because those are put aside for you for your retirement. And you have no control over that because the agency is controlling that money. And then you get this net paycheck. And from there, now you have to still pay the taxes on your income.
Exactly.
Yes.
That's the
It's
way that
as
we need to
simple
start.
as possible for our audience, for those that are employees and are having a hard time understanding where their paycheck and the taxes are going.
Exactly. And see, and this is the importance of this type of information that you're putting out there, is that the education and the value behind this, because once you start understanding this, now other things will start making sense. When I sit down with you and I'm gonna tell you to start doing certain movement, at least you have enough understanding why we're gonna go in this direction.
Yes.
Instead of simply, let's do it, and you're like, oh, like 90% of it, no idea.
Right.
So I want to move our clients is to the 10%. I want to move our clients, in more in the direction of the 10%, so they're better educated, and we can start making some strategic movements.
Absolutely.
So again, active is going to be your wages. That's the worst type of possible tax treatment you're going to receive, because again, it's subject to Social Security or FICA tax, in addition to the ordinary tax rate.
Mm-hmm.
Another piece of information to understand is that the United States, here in the United States, approximately 88% of the revenue, the tax revenue, comes from this source. So again, think about it. Why is that? Because that's where the bulk of the money comes, of the tax revenue, comes from this category, this bucket, the active. And all employees pay taxes. Even the individual that received the refund. Again, it's a misinformation when sometimes you see it's that what could happen is because of their income level, they may not pay income tax, but again, they're paying FICA tax. That's a tax.
True.
Forget about it. And sometimes again, that's that kind of misinformation. When they again receive this refund, they get so excited, but they are forgetting is I paid FICA tax. If you're self-employed, for example, running a landscaping company, your tax preparer probably told you, no, you're hardly paying any taxes because, there was some deductions taken. But again, you're not getting the complete picture. And that is because the self-employment tax.
Yeah.
That is not refundable, meaning you can actually, in some cases, and this happens, that, you see this individual that have they have zero taxable income, and they still pay self-employment tax.
Mm-hmm.
Because they did have a profit, even though through deductions, the standard deduction, for example, probably wiped out your net income on your Schedule C.
Right.
But they end up still paying self-employment tax. And sometimes they're like, what just happened? How can that be?
Yes.
And that's when they realize, the self-employment tax.
Exactly.
You know what I mean? That's when you realize that even when you have zero taxable income, you still have to pay tax.
Yeah.
And so what happens most of the time for most people is it get masked. You know what I mean? Either because it's on your W-2, like you said, you don't feel it.
Right. You don't feel it. Yeah.
Exactly. Or you're self-employed and you had other taxes in netted, and at the end you get a refund. And that's what a lot of people, their target. That's their tax plan is, as long as I don't pay, I'm okay.
Right.
As I don't pay, I'm okay. No, that's not tax planning.
Yeah.
So
yeah, absolutely.
Keep in mind, as a simple example, an individual, self-employed, Let's say, for example, this example of a landscaping company, small
Sure.
company that say nets $100,000 in his or her landscaping company.
Yep.
100,000. This company on self-employment income will pay self-employment tax will pay over $14,000. It's not little money. I mean, $14,000 that if no planning is done,
Right.
this individual will be taking from the bank account $14,000. So it's something that individuals need to start learning before we start talking about some of the specific strategy. That's why I wanted to focus on this first, and at least on today.
Yeah.
Is kind of the 101. Kind of the basics of income and how's it being taxed. The second group is going to be your portfolio.
Mm-hmm.
Portfolio, basically, you gotta think of dividends and interest. That's gonna be, as an example, that's gonna be what it goes into that category. It's another source of income.
Absolutely.
And it's not what is the advantage of that? It's not subject to FICA tax.
Correct.
Now, as an example, let's say you loan some money to your friend or to a colleague or something like that. You loaned some money and they're paying you some interest.
Mm-hmm.
That interest, it will be subject to ordinary tax rates, but not to the FICA. So right there, you're just gonna see that I'm shifting some of my sources of income to portfolio, and that portfolio income now is getting a better treatment.
Right. So to simplify this example, so that 10%, let's say, the person that's, loaning the money out. So then let's say they ask for a 10% interest. So the 10% interest I earned that year, that would be taxable at a different rate, and it's not, subject to any Social Security, Medicare, any kind of tax. So what is the average rate of the tax on that kind of interest earned, for example?
Well, the interest is subject to the ordinary based on the level of the income, overall income of the individual.
Understood.
Yeah. And so that's why you see a lot of, especially elder, the rich auntie, uncle that you're going to launch a business. They don't want to get involved in the business. You know what I mean? So I'll give you an equity. They don't want that. And the reason is they're not stupid. They're smart. What they're doing is that they're shifting is to, they don't want to get into becoming, going to the other bucket, the active.
Correct.
Lending you the money, just pay me the interest. And that interest that I earned is not active, is actually portfolio. I'm going to pay lesser amount.
Absolutely. Absolutely.
So that's now the other part of the portfolio is going to be your dividends. Now,
correct.
Dividends is a powerful way to earn some income that is going to also receive a preferential treatment, and the reason is because then is capped at 20% as of today. You know what I mean? There's some discussion out there. If it falls into what we call qualified dividends, that's going to be your U.S. corporations. That's going to be your IBMs, your Coca-Colas, GM, and things like that. And they pay dividends, and they're very, very solid on doing that. You know what I mean? So those are very good sources of, if you're looking for that type of liquidity, they pay dividends. You receive a preferential treatment on that. So, and the rates, depending on your income, is going to be 0, 15, or 20%. So you right there, and it's not subject to FICA. See, right there, you're starting to cut.
Right.
That's again why you see some elder, wealthy individuals that also you see them. When you look at their taxes, they have a lot of money shifted into buying stocks, and a lot of them buying stock that pays dividends, because then they get in liquidity, but they get in it at a lower rate.
Right, so, definitely.
If you as an example, let's say an individual that has a W-2 with 100,000, that individual probably was going to be in a over 20% tax bracket. You can have 100,000 in dividends, and you're going to be capped at 20%. So even that differential, couple percentage points, it's going to make a difference. You know what I mean? Everything you can do to start shaving some of that tax is start making a difference for you. So how you're earning your income is going to make a big difference. we talked about the active portfolio, and then the third category is going to be your capital. Capital income is going to be, think of real estate and owning stocks, more like stocks in your own company. Those are going to be the entrepreneurs that built a business, and now they have a business that actually has valuation. And again, it's not limited to the wealthy. You think, a lot of people think that this is for the Bezos, the Musk, and no, even your own company. If you build a company that has a good valuation, a good system, it does have value. That stock is a privately owned stock.
True.
But it still has value. Now, why this category is important is because, again, you receive a preferential treatment. The rates are, depending if it's a long term or short term, it's going to be, if it's a long term, which is the ideal situation, it's going to be taxed at 0, 15, or 20%. It's not subject to FICA tax. And again, that's why you see a lot of the wealthy is putting a lot of their effort is in capital. And also capital losses, you can use it to offset capital gains. But also in addition to that, you can take up to $3,000 and reduce any ordinary income that you might have. For example, your wages. Let's say in your own corporation, you have a W-2 and you have some capital losses. You can take up to 3,000 of those capital losses. I'm going to reduce this, which is not my best tax treatment, and I'm going to shave $3,000 of that, which then, again, this is why it's so powerful, capital asset. As I mentioned before, the capital assets are the wealthy friend. You know what I mean? They love it. So it allows you to do a lot of tax planning in that area. The other thing is, we talked about long-term and short-term. Short-term in why I'm not here to how can I say this? You have to be careful every time you're buying, selling stock. You're causing a taxable event.
Sure.
So if you're into the short-term, you will be taxed, and that tax, even though it's considered capital, because again, I have had this situation. Oh, but I thought capital gains are taxed at a lower rate. Long-term capital.
Long-term, yes.
Not the short-term. The short-term will be taxed at ordinary. Because in essence, you got to think about if you're doing this on a regular basis, almost in essence, this is active.
Right. It's like you're trading on a daily basis.
Exactly.
It's earning it on a daily basis.
Exactly. So the day traders, I remember when the boom of the day traders, and they got a big shock when they started being taxed at a higher rate. And again, misinformation. People, even as of today, people are getting into the cryptos and things like that. And every time you're buying, selling, is that though you're causing is short-term capital gains, and those will be taxed ordinary tax rates. So you basically killed a preferential source of income, and you moved it in essence to the active.
Right. Right.
What else? And also to be careful, especially when you see in your when you put certain monies into an investment account, and you see the financial advisor moving money, moving, and that's what we call churning. You know what I mean? It's basically the money is being moved, and it's causing taxable events for you. So what that's going to do is you're going to get taxed at a higher tax rate. The wealthy, if you really analyze, it's long term. That's their strategy. It's not about me, doing day to day. They work very hard at their business. Their focus is in improving cash flow, improving valuation of their businesses. That's why they're constantly looking at the valuation of my stock. You know what I mean? You start at ABC Corp. They want that stock of ABC Corp to go higher.
Higher and higher.
Exactly. Yeah. And they want to improve the cash flow. And there's reasons for that. But at least I'm going to share with you today, one of the reasons is because in talking about our friend Elon Musk, is what they do is, okay, so why they focus on increasing the value of the stock is that you can borrow against that.
True.
So that's what instead of selling, you know what I mean? So
absolutely,
they do is they borrow. Now, what you borrow is, guess what? That is not taxable.
Absolutely, because especially when you're a company and you want to grow and you have other projects, you're going to have to use your assets that you have to get that next loan out to fund that next project. So, and that's not a taxable event, like you said. You're right. Yeah.
So again, and it's available to you and I. I mean, it's available to anybody listening to
Absolutely.
this. It's available to
Absolutely.
all of us. It's not exclusive to Bezos, to Musk, and all these other people. And I'm
Yeah.
using Elon Musk. I keep mentioning him. It's because a conversation I had a few weeks
Yes.
ago, and I'm telling you, this individual was livid. I mean, like, and I was looking at him, and it's like, but don't you understand that what he's doing? You know what I mean? But that's what kind of made me realize. I said no. It says that about 90% of the people have no idea.
Yeah.
They have no idea how this works. So the stock, going back to the capital, the same happens with real estate. Now, this is very common in real estate investors. They understand it better because they know that they have this asset. I bought a property, I increase the value, I do an appraisal, and then go to a
Right.
bank and I can borrow against it and buy another property, do the same, buy another property, and then all of a sudden I build a portfolio of real estate with probably my first investment that I made. If I made it really good, I can continue doing that, borrowing against the first and then against the
The
second.
first
And so on.
asset. Right.
Exactly.
Right.
But I'm not causing taxable events.
Absolutely.
You know what I mean? So it's those kind of strategies that can allow you to build that type of portfolios and that type of income, and you can cash flow all of those real estate investment. And guess what? As long as you have strategies in place, there's no tax.
Correct.
And so
Correct.
that's how they get farther and farther ahead. That's how our clients are getting farther ahead. And anybody listening to this, how can you get farther ahead is by implementing. I would suggest a call to put it in the chat. That there's ways
Yeah.
for you to advance in this game. The reason that most of you are getting hurt is that you don't understand the rules of the game. And any game, doesn't matter what it is, if you don't understand it, you start playing a game, you don't know the rules, you're gonna get hurt.
Right. Absolutely. Absolutely.
So
Awesome.
that's again in a summary, very superficial, very high level. But I wanted to start with that because it's important that individuals understand that there is a different tax implication of where is my source of income.
Right. Right. Absolutely. So, and I know just because of time constraints, so we've covered all three aspects of the three different main areas of income. So then let's kind of explain, because a lot in the media, they talk about, let's say, people like Elon Musk or Grant Cardone, or the billionaires of the world. They mention net worth. Let's explain to our audience, the difference between when we're talking about their income, and which is taxable, and their net worth. So
Yeah.
that's a big area, I think. So, and I think that would be a great way to kind of, close out this session, because there's just so much more to talk about for sure.
Yeah, and that is very good, because again, what the media loves to do is that they talk about net worth, business net worth and all that. People again don't understand that what is taxable is what flows into your tax return. Again, why they put so much effort in the valuation of their companies is because that value, the net worth, is not what is taxable. You can have a net worth of, I don't know, call it whatever number you want to put, a $1 trillion net worth. Doesn't mean that you're going to get taxed on $1 trillion, at least in the United States, and at least as of today. That they're not taxing net worth. They're taxing is what is income, what flows into your return, and also income that flows through your return, which is a subject for another day. But to clarify, net worth is not taxable income. And again, why the wealthy focuses on net worth and not so much about having taxable income. And again, that net worth now becomes important is because they know that I can borrow against it. I can go to a bank and they're gonna look for what? Give me your personal financials.
Exactly.
Why? Because
Yep.
they're gonna give you on the net worth. You know what I mean? Your
Yep.
stocks, your real estate, and they know those are assets. And God forbid something goes wrong with me.
They're going to come after.
I have the stocks, and guess what? They love to own a good portion of Amazon and a good portion of Tesla and all of that. So.
Yeah, exactly. So anytime, for example, this might be a familiar situation with most of our listeners. When you go to the bank to ask for, a mortgage, right? So the first thing they're going to do, okay, not only your income, but they're going to say, what other assets do you have? They actually put together your net worth, and they look at that as well. Okay, what investments do you have? What is your retirement? What is this? They're gathering all this information. You're like, whoa, why are they asking all these things? But I mean, there's a reason for it, because they're looking at your net worth, and then based on that, based on your net worth and the current income that you have,
Right.
they're gonna put together the right amount that they are willing, the risk they're willing to take to give you an X dollars as a mortgage.
Right.
So anything that you're doing, it's going to come back to that. So that's the difference between income that you're earning and income that is possibly that passive or investment income that is taxed at different levels, and then your net worth, which is just basically all the assets that you have. And then that's going to help you borrow against. I hope that helps our audience kind of differentiate between the two. This was definitely such a in-depth conversation about these very simple topics. I mean, we take this, early beginning, accounting 101 type of thing, but just two main subjects, but it is so interrelated and very definitely confused by many. So I hope, our listeners, I hope you enjoyed this conversation. We'll be continuing, our tax planning kind of conversation next week. Just a reminder that next week, Thursday, is Thanksgiving. We wish you all a happy Thanksgiving. But we will see you on Tuesday instead, November 23rd at 10 a.m. So we will see you before Thanksgiving. And then it's just a replacement. And then we wish you all a very, very wonderful rest of your week.
Wonderful.
Have a wonderful day.
Take care.